So normally CFA can be started with either quantitative methods or financial reporting and analysis. Both are safe. But in some cases of financial reporting, there are minor calculations for which it's better to do QM. Now, why QM? Because if you do quantitative mathematics, that is, when you complete QM, there are topics which becomes very easier for you. I'll just name those topics which are going to be absolutely connected to your topics of QM. Those are corporate finance, equity valuation, fixed income. These are, and the portfolio management. These are the topics which will become very easier if your quantitative mathematics is very strong. If your calculation is very strong, these topics will become very, very easier. So honestly, the QM content is not as much as, as you will see in my notes. I've made a bit more exhaustive content for QM. And the reason is that what I realized that later on students have some calculation difficulties in fixed income and equities and so on. So I've included those difficulties also in QM. So when you're doing QM, the focus is just not QM. The focus is also how the calculations will work in fixed income, equity, corporate, and portfolio. So in that way, I've created the content. So now I'll repeat again. Yes, you have the Schwezer notes. In the notes, you have all the description, you have all the questions and solutions and everything. That you can definitely practice. But there are a few places where Schwezer is not sufficient and there are some complicated concepts which are not included in Schwezer. And that's where institute notes are very handy. So my notes will be a very good combination of institute notes and Schwezer notes. Once you do the notes that I've made here, you can easily do Schwezer or you can do institute sums also. Now, should you do the institute sums? Well, honestly, I would not recommend you to do now unless and until you complete the notes and Schwezer notes. For solving questions, you can solve question banks from various places. I will also share you a lot of question banks in your mock test. So don't worry about that. So 3 things: attending the class, self-studying, as well as solving the mocks. These are the only 3 things required for you all to clear CFA level 1. That's it. Correct. And yes, in between, whenever in the session, you have any doubts or anything, please hold me and stop me and you can ask me. And if you want to share anything, because CFA is a complete practical topic and most of you all who are doing CFA have already either pursued some post-graduation course in the past. So of course, you all are not doing CFA now to, just pass. I'm sure this is the degree, probably the first degree that you all have chosen to do after your graduation. In the sense that, we all have the first degree like CA or MBA that we have chosen because our friends were doing it or because, our family told us. But CFA is, you all are putting your hard-earned money in CFA and you all want to have that edge in the career now, right? So to pass CFA, everything that I will ensure that passing stuff, I will take care. But since all of you all have some of the experience, many of you all are working in bank, in retail, in stock markets, in derivatives and all, in fund advisory. So you all can also share your experience. Don't be hesitant. Just let me know and you all can share the experience with whatever the content is. Because I've never seen CFA content which is not connected to market. So every time when you all will be doing CFA with me, you all will connect it. Okay, this is something that I had experienced. For example, when I'll do derivatives and if you experience, okay, these are the option strategies that even I had tried. So do discuss that. If I am doing alternative investments and if you all have done some sort of a strategy in mutual funds or private equity in your work, in your banking profile, you all can definitely share with me. Correct? So that's it. So that's all about, the program. Few more instructions I'll discuss at the end of the curriculum. I don't want to waste your time for now on that. So quickly focus on what QM is. There are 6 readings in QM, which you see on the screen. It starts with reading 6, 7, 8, 9, 10, and 11. The first reading is time value of money. Most of all us, have actually experienced some sort of time money calculations in our graduation past, basically future value and present value. So every time value of money concept that you all had imagined or done till now is is visible in this particular topic. We'll take maximum time here. Mostly our today's entire session may go in time value of money and maybe in the next session also. Then the second topic will be about statistics, mean, standard deviation, and variances and all. Now, why are we going to read second topic? Second topic we are going to read because in finance, we are going to deal with numbers. How to predict the numbers? That is only possible through some statistical concepts. So to analyze data, data is gold. Mukesh Ambani just said in his 2 years back AGM that data is the new oil for me. And some people say data is the new gold for me, right? So we are living in a world where everything, data is a new currency. The one who has more data has more value. The fintech companies which have more data, they are more valued these days. Everyone is just behind capturing all the data possible. So how to analyze the data? That is what the second topic will be, statistical concepts and market patterns. And then comes the enemy of our commerce students. Why do I say enemy of our commerce students? Because most of the commerce students hate this topic called probability. Probability, as a commerce student, I always hated it because most of the things were bouncer for me and I was not good with maths. But here, all this probability and common probability distribution, trust me, even I didn't like it, but here you will love it because you're going to connect it with how to make money, how to do analysis. And analysis, which your curriculum is done through only two ways. Is through some statistical and some quantitative methods or through astrology, of course. So we are not going to do astrology. We are going to focus on the statistics, right? So yes, so probability, common probability, sampling and hypothesis, these are more of a complicated topics. A lot of things new for you, but don't worry, it was new for me also, and it will be very, very, very interesting things. So right now, the best advantage of CFA compared to other courses that you all had done, you don't have to go and write descriptive answers in level 1 at least, right? Neither you have to do in level 2. So there's no pressure absolutely here to remember things. You don't have to remember the concepts. Okay. So there's no pressure that how will I write this in exam? No, you just have to think that, okay, what they will be testing about this in exam. So there will be lengthy questions, but you don't have to write lengthy answers of these in your exam. You just have to solve the crux of it. You just have to do some calculations or solve some concepts there. So it's very easy. Don't take the pressure that how will I do it in exam. I will test in mocks, and the mocks will be, you'll love the mocks also. Don't worry. So let's start with first time value of money. The first reading that we have, reading number 6. Okay. Yeah, in between, anyone wishes to ask anything? Okay. So, guys, on your screen, I'm sure everyone must be seeing the index. So before I start every topic, we'll have an index. Index is like the short trailer, which will tell you that what all things we are going to cover. So two things in time value of money. First, the difference between present value or future value that we are going to see is basically because of the rate of interest. So what is rate of interest? What are different types of rate of interest? What is compounding? What are types of compounding? And how this interest rate is derived? What are the components of this interest rate? That is first part. And in the second part, based on that, we are going to do all the calculations, the present value, the future value of one cash flow, multiple cash flows, annuity, perpetuity, amortization. Amortization is basically the loan calculations. And finally, we'll see a few case studies where we will be dealing with retirement planning. And the best thing, how all this is done in your magical calculator. Your calculator is, trust me, absolutely magical. It's only and only made for CFA curriculum. And this is the only calculator allowed. So all the functions, all the complicated functions that you all were probably doing in the traditional calculator during your graduation exams or, your CA or other exams, here, the scientific calculator, it does all the job. It does a lot of job which is done in Excel also. So I will show you a few Excel calculations also for amortization and all, and I will show you how that is easily done in the calculator without doing lengthy calculations. So let's start the first thing, that is the concept of interest rates. So what is time value? Well, time value is the relation between the cash flows at different point of time, right? So it gives you either the value in the present or the value in the future at a particular rate. So there are four major components in time value: the present value, the future value, the rate of interest, and the time period. Now, the difference between the present value and the future value, the amount difference, is basically because of the rate of interest. What is interest rate? Interest rate is nothing but it is the compensation that someone requires for lending the money, for giving you the money, right? So interest is not free. This is what we had heard. Money is not free. There is some interest rate. This is what we had heard traditionally, but today we live in an era where some people can argue that there are many banks where the interest rates are actually zero, right? And then there are many banks where the interest rates are actually negative, right? Anyone aware about the fact that interest rates are negative also, or zero?
Yes, sir.
Yes. Okay, so I'll just share you a screen share of what are the current interest rates in the market. Okay, everyone visible the screen, the interest rates? So these are the central bank rates of few of the countries. If you see there, what is the central bank rate that you can notice about? Let me go back, go to our country, India. Yeah, in the Asia part I will get. Okay. Okay, so let us go to the rate of India. What is the rate that you notice for India? Visible, everyone? How much is the rate that you all can see, the rate of interest for India?
4%.
4%, right? Now, if you notice, these are Asian countries where the rate is around 4 to 8%. And in few countries, the rate has gone to 27, 18, and so on. And why is that so? Because these countries are facing extreme financial and political turmoil. But when you go to the European nations, when I'll now connect to the European nations, you'll see there the central bank rates are very much around 0, 1 or 2%. And in most of the cases, if you see, they are virtually 0. Correct? But in the bottom, what you see, an interesting part, right?
Negative.
Negative interest rate. So we live in an era today where it is strange that, you know, some of the countries have negative or 0% interest rates. If I go to the South American nations or, you know, the African nations, they have extreme interest rates. For example, if you see on your screen, Venezuela and Argentina, they have 30, 40% interest rates. That is too much, right? And when you come to, you know, somewhere between Europe and South America, if you come to Asia, you have interest rate around 4 to 8%. Now, that is the cost of money in different parts of the world. Now, why is that so? Why is that so? Why is interest rates higher in Venezuela compared to Europe? Any idea?
Inflation cost.
Okay, very good. Inflation, correct. Inflation is one of the biggest component of interest rates. So, second thing, I can also say that the risk, assume, why is interest rates? Interest rate is basically on the bonds that these governments will issue. When I say these are the interest rates in the economy, they can be the central bank or the interbank rates, at the rate at which the central bank gives money to the bank, or they can be the rates at which the government of that country issues the bonds. So when the government of that country issues the bonds, so government will issue the bonds, and that's the lowest rate in that economy. That's the reason why whenever governments issue bond, we call it as risk-free rate. But it is risk-free for the people of that country, right? Because the government has access to printing their currencies. But if I'm an American citizen and if I want to invest in Venezuela's government's bond, that is not risk-free for me because there's a currency factor also involved, right? And in the past, countries like Venezuela and Argentina have defaulted on their foreign bonds. Defaulting on foreign bonds, why is that so? Because to repay your foreign bonds, you have to have foreign currency. And these guys don't have the access to printing dollar. They may have access to printing Argentinian peso or Venezuelan currency, but they don't have access to printing dollars. So every time, whenever we see rate of interest is actually a component of not only inflation, but it is also a component of risks. And there are various types of risks. That's what we will be seeing. So this rate of interest that you see on your screen, right, that is depending on two factors. One is the risk premium and second is because of inflation. So at the end of the time value, we will actually discuss that how the rate of interest is derived. But that rate of interest, however it is derived, we know that that rate of interest is going to be the required return for somebody. For someone who's going to invest in those bonds. It can be a required return. It can also be called as the discounting rate, or it can also be called as opportunity cost. So that rate of return actually becomes the base rate or the benchmark for people to evaluate their investments. So why is interest rate used? Interest rate is not only used to find the borrowing or the lending cost, but it is also derived to understand what is going to be your required rate of return. It has different names. It can also be called as discounting rate. It can also be called as opportunity cost. So generally, interest rate in the world are just not used for borrowing and lending. They are also used as a reference rate for your investments in equity, for your investments in real estate, for your investments in project. They become the minimum rate for a lot of people. So here the reference of interest rate is just not the borrowing and lending rate. It is much beyond that. Okay. Now, of course, who are the people who derive or who decide what will be the interest rates? Who?
The one who
Sorry?
The one who are receiving it.
Okay. So basically, anyone and everyone who is dealing with money, yes, the borrowers and the lenders, right? They are the ones who create the demand and supply. Correct? So these are the guys who are going to decide the interest rate. Normally, I get an answer that, sir, banks are the ones who decide the interest rates. Well, we used to live in an era where banks, the central bank had the power to decide the interest rate. Now we live in a more free economy where the central bank tries to influence the rate, but they are not the complete ones who decide. For example, in India, the banks have the power. It's now more competitive. So banks decide what will be the interest rates based on the demand supply. Of course, State Bank of India does the first step and then others follow, right? In US, it's completely independent. The banks there decide. The banks are bigger than the government there. That's the reason why Wall Street or US banks have more control in the US economy. Whereas if you go in Chinese economy or when you go in many of the Gulf states there, the central bank has more control. So it depends on what the regime is, right? But overall, these days, it's the borrower and, the lenders who, the demand supply, the corporates have become so large, the institutions have become so large that they derive what the interest rates will be. And of course, global banks also have a control on the interest rates, especially with the reference rate that we all know, that is LIBOR, correct? Okay. So guys, now we have known what is interest rate. Now let's go to the calculation of interest rates. So you all have heard about simple and compounding rates, right? Can someone tell me the difference between simple and compounding before I go to the calculations? Anyone would like to share? Some basic, what you see on your screen, the first part that I've done is a simple interest calculation, where I've taken $100 and I've applied 10% rate. So at the end of the first year, my future value is going to be 110, right? In the second year, what you notice is that my interest is calculated on 100 only. And in the third year also, my interest is calculated on 100 only. So what's happening here that every year only $10 is received. However, if I see that in the compounding aspect, what will happen in the compounding aspect? If my present value is 100, in the first year, the rate of interest will be 10%, which is $10, and the future value will be 110. Sorry, if you can unmute, someone has, background noise there. So the first year, you don't find any difference in the first year. The difference will be probably from the second year. What is the difference here? In the second year, my interest of 10% now will be calculated on
110.
110. That's the biggest difference. And due to this, my future value will now be 121 in this case. Correct? So in the third year, my present value will be not 120, but 121. And now I will get interest of 10% on 121, which is going to be 12.1. And my future value will be 1. Can you just calculate in your calculator? 121 into 1.1. It will be 133.1, correct? Right? So what do you notice the difference here? The difference between simple and compounding. The biggest difference.
I get interest on my interest.
Absolutely. Under simple, you are getting the interest only on the initial principal. But under compounding, you are getting interest not only on the previous principal, but also on the interest that you received before. Right? So, can I say here, the underlying assumption under simple interest rate is that at the end of the year, when I got $10, I actually withdrew that $10 and took it back. Correct? But under compounding interest, the assumption is that my $100 was invested, I made $10 on it. And in the second year, I was invested with that $10. I did not withdraw that amount. So by default, the assumption under compounding is that you have kept your initial principal plus all the interest that you accrued, it was still kept in the account. You did not withdraw that. So whenever someone tells you compounding interest by itself, it means that you were invested till the last. You did not withdraw anything. If you withdraw something from between, then you won't get the effect of reinvestment. So when you invest in bank for 5 years or 3 years or whatever years, but if you are going to withdraw the interest, then the returns you are going to get is simple interest. However, if you invest in a bank for 5 years or 3 years or so on, and you don't withdraw anything, which means that whatever the interest that you have, even that you don't take home and that is auto-invested or reinvested, then that's the only point where you get the compounding rate of interest. So in financial world and in CFA curriculum, what are we going to do? We are going to do everything compounding. We are not going to do simple. Our entire CFA calculation will be based on compounding, but that itself means that you were reinvested. Correct? So no one is going to tell you in the CFA curriculum that were you reinvested or not. By default, it means compounding, which itself means that you were reinvested. However, the reason I'm discussing this is that when we will go to fixed income, in few cases, they will ask you, what will they ask you? They will ask you that how much is the reinvestment returns? So in this case, can you tell me what is the return at the end of third year only due to reinvestment? What is the return at the end of third year only due to reinvestment? What was your compounding future value? Your compounding value was, I can say your compounding value was 133.10 future value, correct? Had you not compounded, your value was 130 at the end of third year. So can I say the difference, that is 3.10, is actually the difference only and only because of yes,
Reinvestment.
absolutely, because of reinvestment. Now this difference is only because you reinvested. Now this difference will become larger the more the number of years. So when the number of years increase, this gap will become much, much larger. So now to understand this, what is simple interest? It is interest calculated only on the principal, but compounding is calculated on principal as well as the interest accrued earlier. So simple interest does not consider reinvestment, but compounding interest is actually the base of reinvestment. It is made because we understand compounding interest, which by default means reinvestment. So whenever in the future now in our calculations, whenever we will do future value calculations, the future value calculation, of course, will be higher with compounding interest or simple interest. Well, that is going to be always higher with compounding compared to the simple interest. And the difference that you see here of 3.1, this difference will turn larger and larger the more the number of years. So the more the period of compounding, the larger will be the difference between the value calculated using compounding and simple interest. Everyone. So it is due to this reason, if you were doing simple interest, your simple interest value will be simply increasing at a constant rate. It will be just $10 for every year in the simple interest amount. But if you see the compounding amount will always keep on increasing. So the gap, this is, I can say, the maturity, the gap between simple and compounding will become larger and larger as the time period goes on. That's the reason why you see most of the analysts or financial advisors in India again and again saying or using this word called power of compounding, power of compounding. That's because compounding, which means reinvestment, and reinvestment means you don't withdraw anything, you keep invested. So all those people who are invested in March 2020, right? Of course, their portfolio are, I'm sure, 60-70% up at least. And all those who had invested in February 2020, their portfolios are same percentage, but negative, right? So that's in market, apart from your concepts being strong, what also matters is the appropriate timing and luck, right? Proper timing and luck, both are also essential. Okay, so any doubts? Anyone with simple or compounding? Pretty much clear, right? Again, remember our entire syllabus until not mentioned is compounding. Only in few cases they will ask you, especially in fixed income, that what is the reinvestment return? So reinvestment is nothing but the difference between your value using compounding or not using compounding. Any questions, anyone? Okay. So now comes the most important thing, and that is the calculator functions. Mostly we'll be using few common functions as of now, and those functions are, I will just highlight, most of the functions that you all are going to use are these functions. What are these functions? If you see, N basically is your number of years. N is number of years generally, but here we say N as number of compounding period. So if you're compounding later on, not now, I want to get you into trouble, but later on, if your compounding is going to be annual, it's fine. If it's going to be quarterly, monthly, then N will be our compounding period. I over Y, your I over Y is interest per compounding period. So N is nothing but you can just assume number of period. I is interest rate. PV and FV, we all are aware, is our present value and future value. PMT is to be used only when there is annuity. Otherwise, you have to put the PMT as 0. If you don't have annuity, guys, if you don't have annuity, your PMT should be put 0. Now, a lot of students ask me the question that why do I need to put 0? It will be automatically 0 if there is nothing, right? But there is a suggestion to everyone that do have the habit to re-put 0 even if it is not 0. Because, you know, what happens at times in rush, you may not be aware that your previous question had something in PMT. And in the next question, if you don't put anything in PMT, it will capture the previous PMT. So do have the habit of putting 0 every time, even if the value is 0. So don't be in the assumption that no, if I don't put it, it will automatically capture 0. No, it will not automatically capture the 0 because your calculator remembers the previous data. So if you don't overwrite the data, it will have the previous data. So it's always better to overwrite it by doing 0. Okay. And my favorite function is actually the function that you use while you do calculation on Excel sheet. When you put formulas on Excel sheet, you know, after putting the formula to get the answer, what do? You press enter, right? So here, like enter, we have a function called CPT, compute. If you see here, compute. So after every calculation that you go ahead, you have to press compute. I think, you know, because of this, it won't be visible. Now I'm sure it's visible, right? So that compute function is what you will be putting up every time. Now, on your screen, guys, quickly, y'all can tell me that how many decimals you have after 0. 1, 2, 3, 4, 5, 6. Y'all can tell me.
4.
4, okay. Anyone has 2 or 1?
So,
okay. So guys, there is a function to change the decimal. Now, how many decimals you'll require in CFA exam? The maximum you may require is 3 or 4, not beyond that. Rarely there will be an occasion where you require more than 3 or 4. I don't remember there are any functions where you require more than 4. So how to change the decimal? Well, just press second here, and then press format. On the format here, you see dot, just press that. Okay, what do you get on your screen? Second, and you press the dot, you may get on your screen DEC, right? DC is decimal. Well, there, if you want to change your decimal to, let's say, 6, so press 6 and press enter. 6 and enter. Enter is right besides the CPT function. Okay. And now press clear. Clear is right on the extreme left, bottom. On your screen now, you will have 0.6 decimals. Correct? Again, I'll repeat, second dot. If you want to change it back to 4, press 4, enter, and then clear. Everyone with me? Anyone unable to get it, please let me know. So I'll repeat on the screen how to do it. You're going to press second and then dot. And then on your screen, you'll have DEC equals to. So if you want to change it to, let's say, 5 decimals, you press 5 and enter. So you press 5 and then you press enter. And then you press here clear. Then you'll have on your screen 5 decimals. Correct? Anyone has any issues with this? Everyone comfortable with this? Calculator, basic functions of calculator. There are various functions. All the numbers that you see on your calculator, we are going to use all the functions. Don't worry. You'll be master of calculator in 2 sessions. Of course, if people can operate iOS and Android without going to coaching classes, operating this calculator will be much easier, I'm sure. Okay. Anyone has any issues with the calculator till now? No, right? Correct. So now let me go to the timeline. What is a timeline? Timeline shows us the time period. Now, the first time period I'm going to write here is 0, 1, 2, 3, 4, 5, 6, and so on. Now, what is this called as? This 0, the 0 point is called as end of year 0. Why? Because this timeline is always as the end of the period. It is always end of the period. So if I want to see what is this point will be called as end of year 3. Am I correct? This is end of year 0. This is end of year 3. But the institute may at times twist you. How will they twist you? They may say the same end of year 0. They may repeat it as beginning of year 1. Correct? So beginning of year 1 for them is nothing but it is end of year 0 for me. So let the institute tell you beginning or end, but for you it is always end. So in the same way, end of the year 3 can also be said as beginning of year 4. Correct?
4.
So I'll repeat, the institute may confuse you by saying the cash flow begins from year 5. What did they say? The cash flow begins from year 5. So let them say beginning. So for them, beginning of year 5 is for me
End of year 4.
End of year 4. This is one rule that we all will follow. The institute will tell you beginning and end and they will confuse, but when you will make the timeline, you will plot everything as the end of the period. Correct? So in the timeline, I have highlighted there that we will always consider it as end of the period, even if the institute tells us the beginning. So this point, I will come back again and again whenever we will get confused. Okay. So timeline will be actually a lifeline. And for whatever the institute will tell us the beginning of year 1, for us, it is end of year 0. For beginning of year 4 is nothing but end of year 3. Beginning of year 2 is nothing but end of year 1. Can there be anything like beginning of year 0? Can there be anything like beginning of year 0? No, there cannot be anything like beginning of year 0. It is basically going in the past, which is not a timeline. Okay. That is only possible if you are watching a Christopher Nolan movie. So, these basic calculator function and the timeline, 2 very crucial things before we do the calculations. Everyone set? Okay. So now we'll see a few cases. We'll see a few examples where I'll first start with future value and then I'll do the present value. So step by step, we'll go ahead. First, I'll begin with single cash flow. Then I'll go with multiple cash flows. So just the example that we did before, there we had 100 as our present value, correct? And in the future, after compounding, after 3 years, how much was the value that we got?
133.1.
Yes. So 100, I actually compounded at 10% for 3 years and I got a value of 133.10. Right? Well, we all have done this manual way of doing it in our calculation. This is nothing but, in this case, the 100 was my present value. This was 1 plus rate of interest. 3 was the time, which I can say n, and I got the future value, correct? This is how we calculate future value manually. But all this labor job is not required when you're doing CFA. It's very easy when you do in CFA. So, how to calculate future value of just one cash flow, using the calculator function. So on your screen, you have a question that is 1A, where an investor invests in a certificate of deposit for 3 years. So he's going to invest in a certificate of deposit for 3 years, starting from today till 3 years, which is end of the year 3, which has an interest rate of 9% compounded annually. Right now we start with annual compounding. Later on we'll add the complexity in compounding as well. If he invests 7,500, now when is he investing 7,500? I can say he will invest today, right? 7,500. Then what will be the future value of his investment? So we are trying to find what will be the future value here at the end of the year 3. This is what we are trying to find. And in between this period, the rate of interest, which is I by Y, they have said is 9%. Correct? So now when I go to my calculate, so first thing that, okay, before I go ahead, let me tell you the way we are going to solve the, the time value of money is using a technique that I use is called as TEC. TEC. What is TEC? TEC is the sequence that you're going to follow with me. Timeline, equation, then calculator. I'll repeat. First, we will focus on the timeline, then on the equation here, which means what you're going to put in the calculator. And after that, you'll touch the calculator, not before that. Okay. So what are the things you have here? Guys, you have the present value, you have the I, you have the N, and you're going to find the future value. Correct, everyone? So in the present value, I will put an amount equal to, in the present value, I will put an amount equal to, guys,
7,500.
7,500. Your N you will, so how to do that in your calculator, guys? 7,500 and press PV. So you press 7,500 in your calculator and then you press PV. As soon as you press PV, on your screen it appears PV equal to 7,500. Correct? Then after that, N in this case will be 3 years. So you will put 3 enter. 3 and press N. Right? Your rate of interest is 9%. Now this is very crucial. So you don't have to write 0.09. You have to simply write only 9 and press I by Y. Automatically it will take 9%. 9 and I by Y. Everyone with me? Now what should be the PMT here? PMT, which means annual amount. What will be the PMT in this case, guys?
0.
0. So just press 0 and enter. 0 and enter. Okay, now we've put all the functions in our calculator. So what you will press is that you will press compute first, CPT, and then FV. Compute and FV. What is the answer you get?
97121.
Okay, 9712.
7175.
Yes, and that is nothing but B, correct? 9712.7. That is your B answer. Now, I think you all forgot to mention me that you must have got this answer negative, isn't it?
Yes.
Can anyone tell me why negative? Why did you get this answer negative? Okay, if not, don't worry. Do one more thing. Now press 7500 in your calculator again. Press 7500. And right at the bottom in the right side, you have a plus minus sign. Do you see that? Everyone? Plus minus sign. I will show you where it is. This one, guys. Reset. Just below reset. Everyone? So when you press that, your value will become negative 7500. And now press PV. Now press PV. Okay. So now again, if you press compute future value, what is the amount you get? Any difference? Yes. What happens now? You did 7500 as negative, guys. And then you press compute FV. Any visible changes there?
Answer is positive.
Answer is positive. What does it mean? That, guys, either the present value or the future value should be negative. The sign should be different. Why? Because one of the cash flow is inflow, another is outflow, isn't it? Both can never have the same sign. This is very, very important thing to remember. What is important thing, guys? Important note here that PV and FV will have different sign. Are you with me, everyone? PV and FV will not be same because one is an outflow, another is an inflow. So they are not expected to have the same value, the same sign. Clear? So if you put the PV negative, your answer will be FV will be positive. If your PV is positive, your answer will be negative. Now I know what's the question running in your head. How will we know what is negative, what is positive? Will we have a choice in exam where one of the answer is positive, another is negative? No. CFA Institute will not do that. CFA Institute does not want to test your positive and negative aspect. No, that's not the case. Because what is inflow for the bank can be outflow for the customer. And what is outflow for the bank can be inflow for the customer. So your plus minus stuff is not tested in CFA. So it does not matter whether you put plus as PV, then your FV answer will be negative, or if you put negative as PV and your FV answer will be positive. This does not matter in CFA. However, what matters that there will be questions where there will be PV and FV both, and you may have to calculate something else. For example, you may have to calculate the rate of interest. In that case, you have to remember that PV and FV, if you put both as positive or both as negative, your calculator will give you an error. So for our understanding, we need to know that the present value and the future value both need to have different signs. Is that clear, everyone? Any questions here, everyone? Yes. So I hope everyone got the answer, right? Easy. So now you don't have to manually put everything. You just, you don't have to put the equation. You just have to fill up all the functions. Everyone clear? Shall I move to the next one?
Yes, sir.
Okay. So in 1B, you are given an investor plans to invest 25,000 in a pension fund after 4 years for a period of 8 years. After 4 years for a period of 8 years. Now, what I want everyone of you all to do there in your books and pen, please draw the timeline. After reading the question properly, please draw the timeline. Done, everyone? The question is, investor plans to invest 25,000 in a pension fund after 4 years for a period of 8 years. So after 4 years, which means my first will be 0, 1, 2, 3, 4. At the end of 4th year, how much is he going to invest? 25,000 for a period of 8 years. Is it written for a period or till the 8th year? For a period, right? So he's going to invest it for another 8 years. Am I correct? So can I say he will be invested till the end of 12th year? Am I right, everyone? If the interest rate is 7%, so the interest rate here is 7%. How much amount will he receive at the end of the investment? At the end of the investment. So basically, I'm trying to again find the present value or future value. Present value or future value. We are trying to find the future value, correct? So everyone with me on the timeline? They have asked that he is going to put the first money after 4 years for the period of 8 years. Clear? So what should be my present value? Anyone? Yes. Anyone can tell me what will be my present value here?
25,000.
25,000, correct. My N, interesting, my N will be
8 years.
8 years. My interest rate they have given is 7. My PMT will be 0. And then I'll get CPT FV. Yes, anyone?
$42,950.
This is the answer, everyone. 42,954. Correct. So, what is important that for how much duration were you invested? That is 8 years. Again, here, if you had taken PVS positive, your FE will be negative. If you had taken PVS negative, your FE will be positive. And that does not matter. Everyone clear? Anyone has any doubt till now? And by the way, the examples that you're seeing on your screen are the type of questions that you will come across in exams. Of course, they won't be as easy because it's the first session. They will be a bit difficult, not too difficult, of course. And I will also gradually will move to that point that how much difficult or easy you have. Everyone cleared? Anyone has any doubts? So what are we into? We are doing into future value of a single cash flow. But in both the examples that you saw, the compounding was annually, right? What if the compounding is more than once in a year? if the compounding is more than one time in a year, which means that the frequency of compounding is more than once in a year, what type of frequency it can be? Semi-annual compounding, quarterly compounding, monthly compounding, correct? What do you mean by compounding? Well, compounding means that suppose you are about to get $12 at the end of first year as an interest. So you have a choice of getting 12 on the investment of, let's say 100, you had 12% interest rate. So you are supposed to get $12 at the end of first year. That is one choice. And the other choice is getting 12% compounded semi-annually. So let's say you are getting now $6 at the end of 6 months and another $6 at the end of 6 months. So now you have two choices. Either take directly $12 at the end of 12th month, or take 2 installments of $6 each at the end of 6 months. Which one do you think, as a rational investor, which one will you prefer for? Getting 12 altogether at the end of the first year, or getting 2 installments of 6?
Compounded one.
The 6th one, why?
Because I'm getting interest on $6 which I received as interest.
Correct. So if you get $6 early at the end of 6 months, you can actually reinvest that for the remaining 6 months, right? And
Yes.
that total will be actually more than the total of $12.
Yes.
Right? So the thing is that when I go from annual compounding to semi-annual compounding, 6 months, which means semi-annual compounding, right? My future value will keep on increasing, correct? Because now I will have one factor of reinvestment in it. So similarly, I can say from semi-annual compounding, if I go to quarterly compounding, will my value keep on increasing or decreasing?
Increase.
Sorry?
Increase.
Increase. So from annual compounding, if I go to semi-annual compounding, my value does not remain 12. It increases more than 12. From semi-annual, if I go to quarterly, it will be more than the semi-annual, right? So, can I say the more the compounding frequency, the more will be the effective rate. The rate won't remain 12 because you'll get effectively more than 12, right? So, what compounding does? The more and more the compounding, the more will be your effective rate. And how many times can you compound? Well, compounding can be done in the discrete manner or in the continuous manner. So what is compounding? Generally, in an annual compounding, the frequency of compounding is only once in a year, correct? However, we will now see scenarios where the frequency of compounding will be more than once in a year. Now, these frequencies are of two types. What do you see on the screen? Discrete and continuous. Can someone tell me what is the meaning of discrete? Discrete? Have you heard this word discrete? Okay. In statistics, discrete means something that you can count. So discrete frequencies are countable frequencies. So for example, annual. When I say annual, that means how many times compounding it? 1 year, only once. Semi-annual is 2, quarterly is 4, monthly is 12, weekly is 52, and so on. But beyond weekly, I can go to daily, hourly, minute-wise and second-wise and microsecond and so on. So we do have situations where the compounding frequency is infinite. And such type of frequencies are called continuous frequencies. Continuous means it is compounding forever. First of all, is that practically that do banks do Do you think banks charge interest rate as semi-annual or quarterly compounding? Do they do that? Do you think banks do charge interest rate or they give interest rate semi-annual or quarterly compounding?
Yes.
Yes. But have you ever heard that banks charging continuous compounding?
No.
No, right?
Maybe.
So the continuous compounding concept is actually in theory. In real life, no one charges or no one gets interest rate on based on continuous compounding. Okay, but then why are we doing continuous compounding? Why are we doing? CFA is all about asking the question why. The reason that you're doing continuous compounding is to find what is the maximum value possible. You know that the answer for quarterly will be more than semi-annual. You know the answer for monthly will be more than quarterly, right? So what can be the maximum rate possible? That is called continuous compounding. And that's what we will be seeing now. So there are two rates. One is the rate that they give you without compounding, which is called as the nominal rate or the stated rate, which is called as the nominal rate or stated rate, RS in short form. At many places they write in short form RS, stated rate. So nominal rate or the stated rate is the rate that is given, probably displayed, the rate given by the bank or so on. But after adjusting for compounding, after adjusting for the frequency of compounding, if the frequency is more than once, will the rate remain the same? Will it increase or decrease?
Increase.
It will increase. So that increased rate is called as effective rate or effective annual rate. So nominal rate is the rate given to you, but whenever the frequency of compounding is more than once, the rate will turn up into a higher rate, and that higher rate is called effective rate or effective annual rate. Am I clear? Everyone? Now, manually, how do we do that? I will show you manually, but in real life, you're not going to do it. So for example, let's say 12% per annum. Let's say 12% is our nominal rate. Okay. And if I say compounding is semi-annually, so in 1 year, how many times will it be compounded?
2 times.
2 times. So that compounding is called periodicity. Periodicity. Okay. Now that periodicity here is denoted by a word called M. So how many times it will be compounded? Twice in a year, correct? So what will be my effective rate? My effective rate is calculated as 1 plus 12%, which is 0.12, divided by 2. Now when I do divide by 2, I break it into half because it's now a half year rate. And then in 1 year, you have 2 times compounding because in 1 year, there are 2 semi-annual. So again, raised to 2 minus 1. Can you calculate this and let me know what is the answer? In your calculator? Okay, I will show you how to do in your calculator. Yes, sorry. So guys, in your calculator, here, first of all, it is 1.06, right? So you press 1.06, correct? Now, if you want to solve something which is raised to, so there is directly a button called square. You see this here? If it is square, you can directly do this. If it is raised to 3, 4, 5 or something, then you'll have to press y over x. Are you with me, everyone? So as of now, you can simply press square and then do minus 1. Square and minus 1. What is the answer, guys? Anyone?
0.236.
Yes, and multiply that with 100, you get an answer 12.2. 12.36, correct? Right? Now, this is something that you must have done manually in the past. But again, as I said in CFA, you don't have to do this manual part at all. Why? Because there is a calculator function. What is that calculation function? Okay. Everyone with me on the calculator function? So, let me show you the function where we will actually get this answer directly. So everyone is going to press with me second, and here is the function called 2. When you press second 2, it works like shift. When you press shift and something, you are actually pressing the button behind that button, right? So what is the amount? What is the figure that here it is written? Icon V. When you press that, what do you get on your screen?
Norm.
Yes, you will get something like this. NOM, correct? Everyone? Anyone stuck here? No, right? So what was the interest rate given to us? 12, right? So just press 12 and enter. 12 and enter. Yes. After that, press this down arrow key. What do you get down arrow when you press down arrow?
EFF.
Okay. Well, EFF means effective rate. But before I get the effective answer, I need to press one more time the down arrow key, because I need to put the compounding. So when you press one more time down arrow key, you get something on your screen called C over Y. Correct? And C over Y is nothing but compounding frequency. So in semi-annual, how many compounding do you have? What is the frequency? 2, right? So press 2 and enter. 2 and enter. Done? Now press the up arrow key again to go to the effective one. So now on your screen, you'll see EFF, correct? After you see EFF, answer is not there. To get the answer, you'll have to press this compute. Press compute and tell me what is the magical answer.
12.36.
12.36, isn't it? Well, I'll repeat the function that we did, but that's how you're going to get the compounding answer. The direct effective answer is what? This is the way we are directly going to get the effective answer. We won't require to do all this manual labor that you see here. In CFA, you don't have to do all this thing. Not required. You can directly get the answer. What did you do? You press second 2. Second 2 is second icon V. When you do that in the nominal one, you did press 12 and then you press enter. Then you press the down arrow key. In the C by Y for semi-annual, you press 2. If it was quarterly, you press 4. And then you press the up arrow key. And when you go to effective, you press compute, you get the answer. Are you with me, everyone? Got it? Everyone. Anyone has been stuck anywhere? Getting the answer? So this is the way we calculate the effective rate. We don't have to do anything manual here. So would you want to try something effective rate? So if you see, Yes.
Sorry, can you repeat like how to clear the functions?
Yeah, just press the down button on the extreme left, clear. That's it. On the extreme left.
Okay. Okay. Yes,
That's
got
it.
it. Yeah.
Now, this example that you see on the screen, I have mentioned that derive EAR. EAR is effective annual rate for semi-annual, quarterly, monthly, and daily compounding. But I've also added one more thing, continuous compounding. If the stated rate is 11, what do you mean by stated rate? What do you mean by stated rate? Stated rate means this is a nominal rate. Correct? Everyone. So the nominal rate is 11%. And the compounding frequency will depend on what type it is. For example, in semi-annual, can someone tell me how many compounding will be there? My C by Y will be in semi-annual?
2.
2. Quarterly, I will write 4. Monthly, 12. Daily, 365. And how about continuous? What should I do for continuous one? There's a function called infinity in the calculator. Any guesses? What should I do for continuous? No? Okay. Guys, remember for continuous, CFA Institute tells you that you can use N as maximum or you can use 999. 999. Okay. Why? Because 999 years with is almost like continuous compounding. Your answer will be close to infinite. Everyone with me on this? If you want, you can write a note on this. For continuous, we can use N equals to 999. N, which means your C over Y, compounding. So instead of N, I will write C over Y can be used as 999. Everyone with me? So now, each of you all can give me the answer. When I go to which function? Second icon B. Second icon B. There you may have the previous data. So what you will do? Overwrite it. How? First on your screen, you may see NOM. Norm is nominal, right? 11, enter. Press the down arrow key twice because after that you have effective. We don't want to see effective. We want to calculate. But before that, you have to press the compounding. So you go to compounding for semi-annual. You press 2, enter. Then press the up arrow key and then press compute. Let me know what is your answer.
11.30.
In 4 decimal. 11.30. 4 decimal. Yes.
11.46.
No, the first 11.30. What is the answer in first one?
11.30.
11.30.
30 only, right? Not nothing else. In 4 decimal also. 3000, is it? Let me check. Second icon B. My nominal is 11. Enter. Compounding is 2. Enter. effective 11.3025 is what I get. Am I correct? I get 11.3025. Everyone is getting this answer? If your calculator is not at 2 decimal, 4 decimal, make it 4 decimal, guys. Because the difference will be very minor. So that's the reason why I'm taking 4 decimal. Now, guys, when I need to do quarterly compounding, I just need to change one thing. 11 is already there in the nominal, right? So you go to the quarterly, go to the C by Y and press 4 enter. Right? 4 enter, done everyone. And then you go up arrow, and when you get on effective, before you press compute, oh, you have already pressed compute. But before you press compute, guys, you already know that the answer for quarterly compounding should be more or less than semi-annual. It should be? Yes.
More.
It should be more, right? So here your answer is going to be higher than semi-annual, and your answer in this case will be
11.4621.
4621. That is what quarterly. Similarly, now you will go for monthly. So in monthly, what you will do? You will go to C by Y and press 12 enter. Press 12 enter. 12 enter, up arrow and compute. So you'll have 11.57
5718.
18 or 19, right? For daily, it will be slightly higher. So I will go 365 in C by Y, enter. And when I go to effective, it will be 11.6260. 11.6260. And finally, when I go for 999, it will be more than that. So compounding 999, effective 11.6271. 11.6271. Clear, everyone?
Sir, can you repeat from semi-annually?
Yes. Which one? So first, second icon V you pressed. Second icon V. Did you press that? Now in the nominal, press 11, enter. Enter. Yes. And then when you press the down arrow, should I show you on my screen? Let me
Yes, sir.
try and show you on my screen as well. Okay, is it visible?
No, sir.
No. The calculator isn't visible on my screen?
Yes, sir.
Okay. So, if you just take this somewhere down. Okay, sorry. Anyone is stuck, please let it know. I'll just connect one moment. Yeah. So, okay, can you walk me through what are the steps that you're putting? Second icon V, you've put this. Nominal is 11. 11 enter. You prove 11 enter. Don't forget to press enter. Then you press the down arrow key. Leave this effective as it is. In the compounding, if you want to do semi-annual compounding, 2 enter. Then press the up arrow key. And when you press the up arrow key, press compute on the extreme top. Compute. Are you getting this? Yes. Now, if you want to change the compounding frequency, then if you want to go from semi-annual to quarterly, press 4, enter, and then go press up arrow key again. And now, to solve this, you again have to press compute. So press compute, and then you'll get 11.4621. In this way, you can just keep on changing the frequency and you'll get the answer. Clear is that? Yes, anyone has any doubt? Everyone cleared with how to get the compounding? Now, why were we doing? Yeah, go ahead.
Have to calculate up to 4 decimals?
Not necessarily, because the calculator will do the job itself. So your exam answers, at times, if the choices have difference of just, very minor difference, then it's, if the choices are in 4 decimal, it's better you go for 4. So as I said, the maximum decimal that the CFA Institute may have is 4 decimal. When you'll go to the question, you'll yourself realize that if you see here, in this case, in the first example, they had given the choices in 1 decimal, right? So my answer will accordingly will be that. Never institute will give you the difference so minor that, they are not trying to test you your decimal, how much is the difference in decimal. See the gap between the choices that they have. Got it?
Yes, sir.
So it's not going to be testing about the mathematical or the technical part. They won't do that. So by just looking at the choices, you'll come to know which decimal you have to do. But definitely here, at times it can so happen that the difference between semi-annual and quarterly or monthly will be very minor. So it's better you extend the decimal if required. However, how many decimals to use, that you will come to know from the question. Don't worry.
Okay, sir. Thank you.
Yes. So now we are definitely going to use this compounding in an overall example. They may not only ask you compounding in exam, right? So discrete compounding means something that you can count. So we just did here the periodicity. In annual compounding, it is compounded once in a year. Am I right? In semi-annual, it is twice. In quarterly, it is 4. In monthly, 12, and daily 365, and so on. This periodicity is called C over Y, which we said that compounding period per year. That how many times it is compounded in 1 year. What happens because of this? Because of this, the nominal rate increases into higher rate, and that higher rate is called, guys, effective annual rate. Am I correct? Now, because of this, guys, your future value will keep on increasing. And what will happen? The more the number of frequencies, the higher will be your future rate, isn't it? Or lower will be your future rate. The future value will keep on increasing the more the number of frequencies. Correct. So can I say 9%, if you invested 9% for 1 year with annual compounding, and if you invested 9% for 1 year with semi-annual compounding, where will you have more money at the end?
Semi-annual.
Semi-annually.
So before I go ahead and do the questions, let's say you are going to take a loan. You are going to take a housing loan. Okay. One of the bank, your local bank tells you that I will offer you interest rate at 5% per annum. Now the other bank, which is a competitor, tells you that don't worry, sir, we'll also offer you at 5% per annum. Which option will you go for? Both the banks are offering you 5% per annum. Which bank will you go for? Yes. Come on. Answer me. If not, then the bank guys will come and fool you, which they do.
No. The one which is compounded annually.
Well, the first and foremost thing is that you need to ask the banker that it is 9% per annum, but my friend, you have to tell him that this information is incomplete. You have to ask the banker that, okay, you told me it is 9% per annum, but tell me what is the compounding frequency? Are you getting it? So whenever someone tells you that the interest rate is 9% per annum, that's it. You need to confirm whether it is compounded annually or not. So let's say here in this case, your local bank tells you that we offer you 9% per annum, compounded annually. And then you come to know that the competitor was also offering you 9% per annum, but compounded quarterly. Isn't it? Then which one will you go for? The local bank which offers you 9% per annum compounded annually, or the competitor which offers you 9% compounded quarterly?
Competitors.
Competitors?
Annually.
You are a borrower. Do you want to end up paying higher or lower?
Lower.
Lower.
So you'll go for the annual compounding.
Annual. Yeah,
If
annual
you're an
compound.
investor, you'll go for quarterly compound. Getting it? So trust me, most of our countrymen actually don't know that, they need to ask not only the rate of interest, but they also need to ask the compounding frequency. And this is something I have seen in many cases. And the bankers are also over smart. They don't tell you the entire information. They say to you, sir, even my bank offers you the same interest rate. Why are you going with that bank? Join our bank. But they hide the information. And of course, now, if you are smart, that you're going to ask them that what is the compounding frequency, correct? So keep this in mind. Everyone,